So, hello everyone, and a very warm welcome to the second session of our Stablecoins Uncovered interview series. This is an exclusive interview series to understand the digital asset space in general and our stablecoin space in particular. With the seal of approval for stablecoins in the US and with the Genius Act being passed, we are now poised to see increased amount of activity in this space. Now, many crypto mouthpieces like the Block have come in support of this highly debated bill and have expressed their support. Where does this leave us as researchers, public policy students, and crypto enthusiasts? To learn to know more about the ins and outs of this stable universe. Previously on Stablecoins Uncovered, we had Professor Yesha Yadav, who joined us from Vanderbilt Law School, examining the legal architecture of digital money and how public and private actors need to find solutions to coexist in this future monetary system. And today we have with us Chuk Okpalugo. He's product leader at Paxos, which is a regulated blockchain infrastructure and tokenization company specializing in building secure, compliant digital asset solutions for global financial institutions and enterprises. Now, he is a recognized leader working at the intersection of stablecoins, payments, and finance. Thank you, Chuck, for accepting our invitation and being part of this conversation. To begin with, could you just introduce yourself and your role at Paxos and share a bit about your journey? How did you land yourself into this stablecoin universe? Was it through unexpected opportunities, or you always had that in your mind?
Sure. And first of all, thank you for having me. I'm really excited to be here. So I can quickly talk about my background, but the long story short is that I've always been in finance and tech. So I started my career in traditional finance, investment banking for 2 years at Morgan Stanley in London, then private equity for 2 years at Silver Lake, also in London. Came over to the US for business school for an MBA, and then joined startups in my summer internship and then since then. And so I've been in startups as a product manager, always in fintech, drawing on my kind of tech investing experience. So the path to stablecoins is a interesting one where the firms that I worked at, the first one was a marketplace for private shares. The second one was real estate financing. And the third one, Paxos, where I've been for 4 years, is really a blockchain enterprise infrastructure company. But my first foray into crypto was in 2017 in that bull run, learning about blockchain, learning about the ins and outs, the technology, what it could do, and its capabilities. And so I think the precipice of fintech is blockchain. AI is another piece there. And so being in a blockchain tech company was always on my mind as someone who was interested in fintech. The first few things I did at Paxos were not necessarily stablecoin related. They were more blockchain related, capital markets, post-trade settlement, tokenization, and so on. But then more recently, for the last year or so, it's been more focused on payments and utilizing stablecoins for payments and orchestration.
Wow, that is some journey. And so you have, for most part of your professional space, have worked in this domain now. So it's true when they say that you're an expert, and we are very lucky to have you. So, like you've just spoken about your history through, like being part in this space of studying payments through tokenization, being on chain, payments in this domain. Let us take a deep dive into the entire journey about stablecoins. And what do you think led to the emergence of stablecoins? Was it in terms of fixing a technological gap, or was it according to the needs of the market that earlier projects like BitUSD and Tether ended up shaping the ecosystem that we have and we see today?
Yeah. And so I guess the idea of moving value on chain is one of the very earliest ones from blockchain and crypto at the beginning. Bitcoin, part of the white paper is to be a peer-to-peer global network. Unfortunately, the price is very volatile, as I'm sure many people are aware. And so its utility for payments is challenged by that fact. However, there have been lots of initiatives to make that happen. So the real trigger for stablecoins initially was as a stable asset on chain to hedge against the volatility of Bitcoin and Ethereum for crypto trading. And so you mentioned BitUSD that didn't quite take off, didn't quite have the liquidity, but Tether paired with Bitfinex, which was an early crypto exchange, was kind of the first of the kind of current asset-backed stablecoins. And the real use case there is you want to be able to sell and not have crypto volatility when you're trading and hold your assets in something stable. And so that is the US dollar. And Tether got its start and really took off as a kind of hedge against crypto volatility for traders. But then there were lots of other geopolitical trends that occurred, particularly in the global south and in China, that when folks are trying to avoid devaluation and capital controls, saw that there's this asset that can be held on-chain in a decentralized way that I can now hold assets into. So what started off as a hedge for trading was also a very, very useful tool to hedge against currency controls and currency devaluation. And those two driving forces, trading is still the main use case for stablecoins right now, but the dollar hedge for volatile currencies or capital controls have really led to where stablecoins are today. And we can talk about now how the building of all the capabilities to support trading, wallets, decentralized exchanges, DeFi, lending, even purchasing assets like NFTs, have created infrastructure that makes it easier to build payments applications on. But that's just a secondary trend that kicked off following the initial trends of trading hedge and a dollar, a store of value against capital controls and currency devaluation.
So there has been a movement from earlier projects which were primarily to provide stability, and hedge against volatility in the crypto market, to now where we are landed with stablecoins. Now it has become mainstream. There are acts being passed to sort of make them be a mainstream product in our entire monetary and financial systems. So in your experience, as we have had this journey of the stablecoins, what were the key features or characteristics that the earlier stablecoins and stablecoin issuing companies had vis-a-vis what the industry has moved towards as of now? Do you see there that they are much more sound, and you think the market has over the years matured a bit more? What is your take on the industry's appetite for stablecoins?
Yeah, so I think there's a couple of things, and they've changed over time, and their relevance will depend on the use case and just how familiar people are with stablecoins. And so you can kind of break it down to having a stable backing. Okay, if you want to be 99%, 0.9% are dollar backed. So how do you make sure that the assets represent that dollar value? That's the first thing. Then there is trust. Okay, sure, you can actually physically move assets into a reserve, but you need people to trust that what you say is correct, that you can manage it appropriately, that you're not taking too much risk. And so there is a kind of trust and transparency angle to it as well. And then there is, call it distribution or utility. Like, how do you actually get the dollar token to be in places or available in places or accessible in places that give it utility? You could have a dollar asset on an exchange on a database. It doesn't make it a stable coin, depending on how it's backed, as long as you've solved the trust issue. But what makes stablecoins interesting is that they can be kind of moved anywhere on chain in a permissionless way. And so how do you get people to, for people to do that, they'll need to have uses for it. It needs to be widely available and accessible. And I think what is still true across all of those 3 points is distribution is key. What started with exchanges, still today, exchanges are a key access point. But what's changing is that there are now more and more firms and on and off ramps for people to turn fiat dollars into stablecoin dollars. And with the passage of the Genius Bill, more financial firms in the US are able to do that. So that's one thing that's true in the past, but continues to be true today. Then the backing assets. I think there's been a lot of talk about what is backing Tether. It has been a bit of a, call it, within industry drama, because there's been accusations of the types of assets and who's holding it and where, and that is improving and has improved over time to look more like the kind of regulatory first issuers today, such as Paxos and increasingly Circle and others, where the assets are very, very safe and trusted by, or even dictated by the necessary regulator, cash equivalents, short-term treasuries, maybe repo, and other short-term treasury bills. And then not only providing specific requirements around what can be held, but then also requirements around transparency, how frequently you need to show what what the makeup of those assets are, and also being able to show that in a very clear and open way publicly, and then also audits by reputable financial firms. And so what started off with a very murky backing has evolved into something very transparent. And firms like Paxos and others have been doing that before Genius, given prudential regulation by regulators like the New York Department of Financial Services and others. MiCA also does a similar thing in terms of its requirements around reserves and transparency. Then going to moving on to the last piece here, we talked about the assets and the transparency and the distribution. These use cases or the availability of stablecoins is definitely changing very rapidly. As more fintechs, as more applications embed these tools into their applications, then the ways that you can use these assets will change and will look very drastically different from how it has been in the past. The options for converting fiat into stablecoins, again, will proliferate and increasingly they'll just feel very seamlessly interoperable with regular fiat.
So I think there is the stablecoins that have followed the right path to becoming more stable by keeping reserves in check, by ensuring that in future when the regulations do come, they have their books in order, will tend to go forward and capture the market vis-a-vis the ones perhaps that are more based off of other cryptocurrencies which are more volatile in nature and algorithmically based ones. Okay, so okay, so for the next section, as we have charted out the space for the history of stablecoins, let's move into something about like the integration with traditional finance. Because now we see that many big institutions in themselves are issuing stablecoins, are bringing their funds on ramp. What do you think are the main hurdles for integrating the stablecoins with TradFi systems, especially when you talk about like know your customers, AML legacy issues, and we did discuss about like interoperability. So going forward, how do you think the future is going to map out when big institutions and financial TradFi spaces are going to bring their assets on chain into the stablecoin space?
Yeah, so I think there's quite a few different areas to kind of tackle there. In terms of integrating between TradFi and crypto, there's a couple of items. I think compliance is one, the technology itself is another. Those are, I would say, that the two kind of main areas. Compliance captures a lot of different things, though, from the definitions of the assets and how they can be treated, from based on the particular licenses of the particular partner, be it a bank, a non-bank financial institution, and so on, to accounting treatment, tax treatment, and other regulations such as capital requirements. So there's a lot on the compliance side of things that need to be or are being addressed and the Genius Bill goes a long way. Guidance from the Fed Reserve, the OCC, the FDIC, and other regulators also goes a long way in terms of providing financial institutions with clear rules and guidance for how these things should be treated beyond just how it's backed and its value. And so outside of compliance and the many different areas, like one can go into more detail there, the technology is also a large gap, even for regular fintechs that are tech forward. There's a different a new technology stack, the blockchain stack, managing keys, wallets, interoperability between different chains, the UI UX of swapping across different assets. These are all things that firms will have a varying degree of success or challenge with integrating. And so I think there'll be many firms that pop up to help legacy banks, community banks, regional banks, with the technology side of things when it comes to interacting with blockchain technology. So I would say those are the two kind of large buckets of kind of gaps that still need to be solved. But then beyond that, there's behavioral. There's how people think about these assets and what they can do, and the idea that a deposit at a bank is a unsecured liability to that bank that is FDIC insured up to $250,000 and not beyond. That as a concept is only so well understood by consumers today. And a stablecoin, especially one regulated under the new Genius Bill, is fully backed by cash and cash equivalents and government assets. No insurance needed, but on-chain. Okay, what does that mean? Well, then there's a custody element. Who is holding the keys? What security is required? Those are two very different paradigms. We haven't even gone into the nature of money and what it means for kind of reserve requirements and things. But just sticking with behavior here, the way that businesses and retail tackle or treat their finances will change. Not necessarily immediately in the West, because I think folks are not necessarily, they've gotten used to the fact that your checking account pays zero. And that's just a matter of fact today. But over time, I think as not just the Genius Bill, but other regulation improves, and it's easier for financial firms to provide yield-bearing assets to consumers in a very easy way, I think that behavior will shift and change. Similarly, for businesses, talking about cross-border payments or treasury, there is a new set of expectations that will occur over time when businesses realize through services and new startups what's possible, particularly around reduced settlement times, reducing the time it takes to do cross-border payments, and cheap rails integrated with payment companies that enable things like micro payments and agent-to-agent payments. Agentic payments is a whole other kind of category and discussion to have, but even within that, there's a whole set of brand new kind of paradigms that we're still learning about. But when you combine some of those things together, you then it requires the rails to be internet forward, to have open networks that can enable 2 points to talk to each other if needed, or they may need to have protocols being just any kind of agreement of communication and method and a set of rules to enable things like on-chain commerce payments, where it's not just peer-to-peer, but there's like a set of smart contracts that may live in the middle that can operate and manage things like chargebacks and other kind of consumer protection factors. So in terms of how the market is evolving, I think, yeah, I would say that there's the two areas I mentioned, just there's a lot of compliance guidance and tooling needs to improve so that existing financial organizations can treat this new asset and rail and platform in a way that fits within their existing businesses and systems. Then you have the technology that it will take some time for people to integrate, and there are partners available that they can work with or they can build in-house, and that those things will happen over time. And I think those two things together are kind of are like the foundation for like a set of behavior changes and expectation changes as people realize what's now possible with this technology.
I think there's much learning to be done because now that we have the acceptance or like the seal of approval I was talking about, people are more interested now to understand more, develop in the space of whether it's technology, whether there's change of behavior. So I think the movement is a beat, the feeling is a beat, and we will see much more happening in this space. But you did mention something about the cross-border payment side of stablecoins use cases. And we were also talking about something like there are regulatory fragmentation across the whole world. And with more geopolitical tensions erupting across the globe, how do you think stablecoins is prepped or is capable or is established well in itself to overcome these challenges? And what is the future of trying to overcome these regulatory fragmentation, whether it's having Genius in the US, Mika in Europe, and something else in the UK? Do you think there is a way forward in sort of achieving an overarching regulation that makes it easier for people to move funds, money across borders, especially in the case of remittances, for families, small payments, whether it is like company to company or it is like from people to people? What is the future of this, and what kind of changes in regulation, maybe, if you can sort
Yeah.
of, yeah.
So I would say I think the short answer is looking at FATF, FinCEN, Travel Rule, there are frameworks for global payments and global transfer. And yes, the technology enables certain things to occur that weren't possible before, like decentralized logic, smart contracts, and so on. But there is sufficient kind of understanding of the core problems to solve when it comes to payments. And we have some of that today. Now, what's new is that each region now needs to come up with there's just two kind of main bodies of legislation, maybe more, but stablecoin issuance, reserves, transparency, consumer protection. I think every region needs to have or co-opt that type of legislation. And then market structure. Do you want trading of crypto to fall under securities? Is it commodities? Is it separate, like a VASPA licensing? And how do those two interact? And between those two plus existing global payments legislation and rulemaking, I think there's a pathway to cross-border payments. Cross-border payments in its own way, there's already a lot of good foundation for it in terms of the rules that are required, and they don't necessarily need to change, but they may need to in some areas, just to adapt the fact that you can now have a originating financial institution and a beneficiary financial institution talking directly together without intermediaries. But in general, avoiding sanctioned entities, protecting against terrorist financing, knowing your customer, knowing your business, are all still relevant. And just given that there's new technology and things move very quickly in the blockchain, but also that blockchains enable this kind of pseudo-anonymous tracking, we can just continue to add to those foundations and those goals with blockchain analytics and other ways to kind of serve the same need of, hey, I want to make sure I know that this is who this is from, where it's going, and what for. You can still achieve those things. Just I think there's a kind of scary kind of cloud above blockchain. One, because like any payment tool is used by criminals as well as for good use cases. But two, people think it's completely anonymous, and it's not. And so if you treat it like any payments rail, you look at the goals of your legislation or what you're trying to do for cross-border payments is often anti-terrorist financing and so on. And you can apply those same rules and say, okay, how do I make sure that I'm comfortable with this risk? And you'll see that there are tools that one can use and rules that one can make in order to make sure that the various different payment institutions in your particular region are following the same kind of risk approaches that they're doing for regular finance. So that's kind of the top level, I would say, for the point around convergence of global legislation for stablecoins trading and then payments. I do think there's work to be done. A lot of that is education work, policy work, to enable firms or countries who have not necessarily spent as much time to establish their own rules. I think at this point, Mika, far ahead. You've got Singapore, you've got Hong Kong, and others in UAE, and now you have the US. And so there's now sufficient timing, but also existing frameworks to build on. But they do need to be interoperable. Otherwise, it's going to be very, very challenging, and you're going to have these silos of regions. And so that's an interesting area to watch out for. The Genius Bill does have a multi-jurisdictional element to it, but it means that global or regional or national legislators do need to interact and talk. But as I mentioned at the very beginning, with payments and cross-border payments laws, we have a precedent for that, and this is something that will take time, but is bound to happen.
I think it's more like the foundations have been set, and now we can use those to sort of like leverage it and build the cross-border payments through stablecoins network on top of that. So I think on the side of traditional finance, as you mentioned, it's more to do with like building on top of the existing rules and regulations in the case of stablecoins. It's like whether it's cross-border payments, whether it's taking legacy TradFi to the next level, it's more so the rails are there. You sort of like build on top of that, make it more seamless, interoperability to be included, and you would find yourself in a space where there are movement of funds which are cheaper, faster, and quicker to settle. So moving on to the next section, where we would speak a little bit more about the
Yes,
regulation.
just on that last piece there, I would say that the rails aren't quite there yet, particularly for certain corridors. And I think there's, with respect to kind of cross-border payments, there's still a lot of liquidity and last mile connectivity that needs to be built out. I think right now there is a lot of traction, and the traction is growing very rapidly, particularly in B2B payments. Thinking about corridors such as like Latin American countries, particularly the ones that have either capital controls of volatile currencies and already have high stablecoin adoption, using those stablecoins to pay for supplies in Asia. Same with, like, say, West Africa, paying for supplies in Asia. So you have the kind of China supply B2B payments trade, but then also US to Latin, US to Africa. And then those I should say the other way around as well. So those are remittances. Then you also have companies who are using those same corridors for repatriation, or enabling businesses and consumers to spend on US online services that are typically in dollars. So those are kind of the key corridors that are seeing a lot of traction today. But there's still a lot of work and connectivity to be done. And so I kind of think of, there's a lot of traditional financial rails that work well today, but it's not perfect, or it's not fully built out in terms of connectivity everywhere. There's certain kind of corridors you can think of, like say Japan to Nigeria, or something that is not as efficient as US EU. There are corridors that can be improved, and I think stablecoins are a very, very good tool to help around the edges and fill out the gaps in the traditional financial system. And I think in the future, it won't be one or the other. There'll be a mesh of both that works well. And so the shortest path from A to B, may change over time, but over time things will become more and more efficient. And I think another point you made that I just wanted to touch on quickly, speed tends to be the main driver. There are certain areas where there's zero access, but in most areas there's access. It just takes a long time. If you go through correspondent banking or through networks of individuals, then or brokers or OTC, and so now with stablecoins, you're able to move the dollars around very, very rapidly, and that enables you to reduce payment time from maybe it's 3 days, maybe it's 7, maybe it's 2 weeks, depending on the corridor. And so it's one of those
Yeah.
things that I hear people talk about a lot, and it's worthwhile saying that. Is it cheaper? Sometimes, like it can be. It's mostly about speed and capital efficiency for when it comes to cross-border payments.
That absolutely makes sense. I think for moving money across, like say, so to US, to the other part of the world, say Asia, it would take like so much time. It's like T+1, T+2, depending upon like the kind of banks that fall in the middle of the financial intermediaries. With this kind, you have reduced that kind of financial intermediation, and the speed could be enhanced. And also for the last mile, there's much work to be done. It has to go to the right peer, the right business, or the right client. There's much work to be done on those aspects as well to meet the last mile requirements. So I think those were very interesting points made with like the integration part with the traditional finance. Now moving on to the next section, we're looking something more about the regulation side of it, and also the part where the Genius Act's sort of way forward was. When we take a step back and look like at the US government debt, what comes across is this debt is not going to be reducing into the future. And now we have stablecoins who have erupted as or emerged as the largest buyers of the US government debt because of the requirement of the reserve requirements, right? So they need to have cash or cash equivalents. What better is T-bills, short-term bills of the government debt or the government bonds. So how do you think this is going to pan out? Because now you have this kind of integration or movement of the government debt. So the US government is moving alongside with the stablecoin issuers. They both need more debt to be there in the market for both of them to survive. So how do you look at it from perspective of a practitioner in this space and not like a policymaker or an economist, but you from the side of an expert from the practice side of this field?
Sure. I would say still today, the supply and liquidity in US Treasury markets, and particularly repo or repurchase agreement market, is very large. It's very liquid. I think if you assumed 250 billion or 260 today of total stablecoin market cap was all treasuries, they would be between the 10th and 15th largest buyer relative to other countries. Still not the largest, and there's still many more that come beyond. And the way that the way that issuers manage their reserves varies, but the balances and the daily liquidity required is very, very well much served today by the existing kind of capital market system. So yes, there's an irony there that this new stablecoin, blockchain-based monetary system is reliant on the strength and liquidity of the capital markets. But from a practitioner's perspective, it is intertwined, but there's deep liquidity, and I think they'll continue to be. Maybe when we need to get into the tens of trillions for that to start to become more challenging. But in terms of like the alignment with the government's goals to find more buyers of its debt, I think there's a very, very clear alignment there, as you've seen Treasury Secretary Scott Bessent mention on various occasions. And there are studies that have tried to show, and I think have shown that the effect of incremental or marginal buying pressure of short-term treasuries does reduce the effective yield at the front end of the curve. And therefore, you are able to create more of a regularly shaped yield curve through short-term treasury demand. And so I think those two elements seem to portray a strong alignment between kind of stablecoin issuance and the US dollar hegemony and its kind of goals from a dollar debt demand perspective. And I would say that what I'm really excited about also from a practitioner perspective is a movement away from TradFi treasury management. And what I mean by that is still want to back stablecoins with US treasuries or US government assets, the cash equivalents. But today we're still reliant on amazing, highly liquid, but still TradFi asset managers. And settlement time on the weekend is challenging. And so either through their innovations or through moving these treasury assets on chain so that the treasury market itself is 24/7 means that for this new set of stablecoin issuers and existing stablecoin issuers, our yield, our treasury management can be 24/7. It's 24/7 today, but it'll be even easier and there'll be much more liquidity at all times of the day. And that requires the underlying treasury assets themselves to be tokenized or part of a tokenized fund. And that's starting to happen more and more. But if you look across all the various different regulators and the requirements for reserves, not all of them have allow for tokenized treasuries to also be a part of it. But as that changes, there's going to be much more liquid, much more on the weekends, 24/7, and even greater interoperability between issuers.
I think that point of they being active during the weekends and after office hours was something that even Yesha Yadav took up in the first session that we had. That is sort of a place where there could be certain challenges that need to be fixed for smooth movement, the treasury management, the reserve requirements of the stablecoin issuing companies. That is something I think work is being done. It's not that people haven't noticed it, but I think going forward there'll be much that needs to be done to ensure this coordination between the two systems. So we will take a deep dive into what Paxos does now. Perhaps take us through what Paxos is, its journey, and how far is it aligned with the new Genius Act? What has it done from beforehand to ensure that it comes across as the market leader, or somebody who can be looked upon as somebody taking charge for this space of stablecoins?
Yeah, so I'll keep it short. There's a lot of really awesome kind of content that we can share to the listeners afterwards about Paxos and our approach here. But we from the very beginning we focus on being regulation first. And so in the US, our stablecoins are issued under the New York Department of Financial Services. We have PYUSD, which we issue on behalf of PayPal, USDP also, and then we also have USDG, the global dollar, that is issued on behalf of a network of incredible partners such as Robinhood, Kraken, now OKX, Anchorage, and folks like MasterCard have recently announced their intention to join, and so on. And that is compliant with the upcoming regulation framework out of Singapore from the MAS. And we also have entities globally and other stablecoins that come out of UAE as well. And so even before Genius was passed, we have focused on building stablecoins that fit a lot of those protections. So and the New York Department of Financial Services is one of the top regulators, and they have laid out a very clear framework for what the reserves need to be, how the firm needs to be transparent in terms of audits and attestations, the consumer protections. Paxos is a trust, and all of the assets within the stablecoins are bankruptcy remote. So if anything was to ever happen to Paxos, the claim on the stablecoin balances would be for the users. And so we've been building from the beginning with that in mind. And so we're very happy to see that this kind of consumer protection and safety first set of rules is also present in the Genius Bill. And we're excited to see how the regions will become more and more interoperable with what's stipulated in the Genius Act, so that we can build a global multi-jurisdiction stablecoin. Today, at the moment, we have a USDG that's regulated both by MiCA in Europe, and also, as I mentioned, is compliant with the upcoming MAS regulations. And so there will be very, very few stablecoins that will be multi-jurisdictional like that. Over time, I'm sure more and more will do the same, but I think we've been a leader in the space at being regulatory compliant. And that's on the stablecoin side. Paxos does a lot more than just issue stablecoins. I think we're mostly known for our stablecoins, but we also, we are enterprise blockchain infrastructure, and so one of the one of our other core products is white label brokerage. So we power PayPal, Interactive Brokers, and others, but we enable them to plug in crypto buy, sell, hold, fully complete with taxes and reporting and others, things like that. And that's another one of our businesses. We also, as I mentioned, we have payments and orchestration and custody. And so we power Stripe's pay with crypto feature, and they use our APIs to generate the kind of the blockchain addresses and process the stablecoins for their merchants. So lots of different things that we do, and we're very excited to see the growth of the overall market as the Genius bill, as you mentioned at the beginning, drives a lot more attention from traditional corporates, fintechs, and financial institutions to this new evolution of the financial system and money movement. And so, we're one of a few regulated firms that can help support these firms on their journey.
Thank you so much for that little bit of deep dive into what Paxos really does, because it gives us a sort of understanding of how this entire stablecoin issuing company function from the back end. So we just tend to study them from the space of what are they issuing, how they're working, but from the practitioner's view, there's a lot more that happens behind the scenes to issue the stablecoins that do reach us in the market. So the other side about this has been the debate about dollar dominance, right? Like most of the stable coins today are dollar denominated. They are pegged 1-to-1 US dollars. And perhaps this is one of the reasons that the Genius Act was passed, is to sort of keep the power of the world in terms of denominating the value in terms of dollars. And the US government support for cryptocurrencies and the dollar-denominated stablecoins come at a very opportune time with the enactment of the Genius Act. So how do you see this entire space looking out for in terms of it still continuing to be dollar-denominated, or you think there are competing stablecoins out there which may not be dollar-denominated, or it could be basket of currencies going forward? And what's your take on this space?
Sure. I think that the majority of stable coins in terms of volume will be dollar denominated, partly because the demand of a lot of the global south, particularly areas where there's currency volatility, is for dollars. And part of that is because dollars are the world's reserve currency. It's like 50% of trade, 80 or 90% of FX pairs. And a lot of it, you can think about how many invoices are invoiced in dollars. And as a collection tool and as a store of value, there was demand for dollars before stablecoins. The euro dollar market, I think, sits at around 13 trillion, which gives you a sense for what the global non-US demand for dollars is and has been over the years. And so I think that is what will keep dollars as the main stablecoin in terms of volume, and call that 99%, or even more. However, the overall market will grow rapidly, and I think the kind of two elements that will drive the growth of non-US dollar stablecoins. One is the resistance against de-dollarization, and so I think governments and central banks will mandate the use of local currency stablecoins. And then I think there will be use cases, particularly for maybe regulatory arbitrage or on-chain effects, or just being able to provide financial services locally in a much cheaper way, those use cases will drive the need for local currency stablecoins. And so I think there will be, and it may start to look like a mixture of FX needs and kind of local currency, local market fintech needs. And so you can maybe take a look at or use the proportion of reserve currencies at governments as a indicator, or overlay the proportion of trade flows from the G7 currencies as another indicator, and then overlay on top of that then the regions where local banking rails are challenged, and it's just easier and faster to build on stablecoins. That's a lot of overlays, and so how will it play out? We'll see. But I think there will be non-US dollar stablecoins, but the vast majority will remain US dollars.
I think when I asked something similar to Yesha, her reply was like, there has been talks about de-dollarization for a while now, but it's very tough when you have set up an infrastructure which is as sound and as deep as it exists for dollars today to sort of like overthrow it. And you may just want to use the existing spaces to build new technology rather than reinvent the wheel. So
Yes.
that could be one of the reasons why there will continue to be more dollar-denominated stable coins in the market.
Yeah, absolutely. I think the behavioral point is an interesting one as well. In many markets that either dollar pegged or dollar have a high propensity for trading in dollars, local retailers, merchants, individuals, you have a sense for what the dollar is, how valuable it is, and what to do with it. And so and that's been built up over decades. And so that's part of the dollar hegemony. But I think it impacts the likely kind of trajectory of non-US dollar stablecoins. I think people, if they can get access to a dollar, they think that they've been working through like local markets and Hawala or like agents to get cash. You can now say, hey, instead of that cash, I can give you a digital version. It's like, great, I was already thinking in terms of dollars, and now I've got it on my phone. So yeah, there are many reasons why I think dollars will remain the dominant stablecoin, but I do think there'll be sufficient market cap in non-US dollars as well. It's just compared to dollars, it'll look very small.
Right. So, because most of our audiences come from the space of research and policy, maybe you could comment on some of the other areas that even practitioners and people who are much into this domain are looking forward for in terms of research, in terms of policy work. One part that we were discussing was the problem of fragmentation with rules, regulatory bodies governing stablecoins, and what are people looking out for in terms of achieving better global coordination to overcome this kind of fragmentation, and how do you place research and what kind of solutions would you expect from researchers to sort of like come about and understand or explain better so we
Yes.
can overcome these challenges?
Yeah. So I think as a practitioner, my goal or a goal of practitioners would be for clear rules of the road. That's super, super important. And there's lots of other things that I care about, but we'll focus on that for now, because I think that's as you mentioned, with fragmentation of the regulatory landscape, that is a key blocker. I think advice, education, examples, even practical or empirical, to help regions and nations move forward with crypto and stablecoin related policies would be the most valuable thing. I think there are a range of progress in terms of understanding. Some are in wait and see mode, some are keen to move forward, but it's just they don't have much to go on. And so this will happen eventually, but I think we can accelerate it with research that looks at why the current Genius frameworks or other frameworks are strong, and how that should be a framework that can be repeated or copied or enabled. I think helping governments to understand the risks of de-dollarization and recommendations on how to manage it. the benefits of moving cross-border payments, particularly in markets where it's very much a black market, on-chain, and what that does for visibility. And with visibility, there's more control. I think that is a very interesting area of research as well. And then I think there is a interesting question to ask. I'm not sure if this is already being asked, but on the economic benefits of smoother or faster, more transparent cross-border payments, or even domestic payments. I think these things are, there are lots of use cases for domestic payment rails today, UPI, SEPA in Europe, PIX, and so on. I think there are ways to advance local market RTP networks, even putting stablecoins to one side. But as a core bit of infrastructure, once local markets have real-time 24/7 RTP rails, then they can be then connected to other markets via global rails like stablecoins. And so you can see there's lots of different angles to take here. But I think if every country or major country that had, fairly technical or wanted to have technical, like a technical economy, I say technical, a digital economy, I think solving for local real-time payments rails like PIX, like UPI, is a kind of foundation step that could be very, very strong for a local government. And then that enables others to build on top and then connect to other local payment rails for kind of real-time cross-border payments, and really opening up the market to foreign merchants and enabling the populace to buy from like the US and so on. That, as long as that is aligned with their policy goals, of course. But I think lower friction local payments is beneficial for many different reasons. But then that's kind of the first step, whilst researching and understanding about de-dollarization and integrating with registered or regulated partners for cross-border payments. So you get visibility and you can move away from black market FX to something that is more visible and more controlled. And so I'd love to see that type of work, showing that the benefits of upgrading one's local payment system and connecting it to the world is more beneficial than the risks of de-dollarization. But again, we have to look at the data, and that's going to be a challenging thing.
Yes, I think the irony has been that earlier, I think the entire space was characterized by something which was a black box run by mafia or something like that. And now it can actually be used to overcome those challenges, to fix those loopholes. And something that part of the research would be very interesting to see as well, that how from being a black box, it is now actually opening up and becoming more transparent for people to use to sort of overcome the challenges we earlier thought they were the key reasons why this space was associated with. Because I did say that there was a surprise towards the end of our webinar, so I'm going to move on to that section, which is actually a rapid fire 5-question answer round. So I'm going to throw at you some really stupid questions, which you have to answer without thinking. Okay, I hope you're ready for it.
Okay.
Okay, so if you could issue your own stable coin, what would you call it?
AI coin.
AI coin. So you're an AI person. All right. So if you were not a product leader and that you had the space to create your own role in this Web3 verse, what would your title sound like and what would you be doing?
CEO, co-founder.
Okay. Which meme coin do you most closely associate yourself with?
None.
None. So you're not somebody who actually delves
Okay,
into the world.
AI XBT.
Okay, AI XPT.
I
Okay.
don't know if that's a meme coin. I think it's an AI bot
Normal
related
token.
coin.
Yeah. Okay. You have to think, you have to answer without thinking much going forward. Satoshi Nakamoto was sort of like, was supposed to be an animal. What animal would you associate him with?
Sphinx.
Really sly. Okay. And finally, the last one. One crypto phrase that is applicable to the general life as well. One phase of the crypto world, the lingo, the tech lingo that you think is applicable to the general world.
Don't trust, verify.
All right. So that brings us to the end of our talk. Thank you so much, Chuck, for taking the time out and being so magnanimous with your thoughts and views. I'm sure audiences would deeply appreciate your technical side of things, and I'm sure many people would reach out to you with further questions. Thank you so much, and we hope that you'll continue to engage with us in the future.
Awesome. Thanks for having me. Talk soon.